WeWork, a name once synonymous with innovation and the future of work, captivated investors with a valuation that reached an astounding $47 billion in early 2019. Its founder, Adam Neumann, presented a vision not just of office space, but of a global community, a lifestyle brand. Yet, just months later, this soaring valuation plummeted, a proposed IPO was withdrawn, and the company faced a near collapse, requiring a bailout to survive. How did a company promising to revolutionize how we work become one of the most spectacular financial debacles of the 21st century? This investigation delves into the mechanics of its rise and fall, scrutinizing the claims, the capital, and the controversial figure at its helm. At the heart of WeWork's narrative was Adam Neumann, an entrepreneurial figure with a powerful, almost messianic, vision. Neumann proclaimed WeWork was not merely a real estate company but a community company, a physical social network. According to early investors, he articulated a grand ambition to elevate the world's consciousness, starting with how people experience their workday. This vision, while inspiring to some, blurred the lines between a traditional business model and a loftier, intangible mission. In January 2019, just before its peak valuation, WeWork rebranded its parent company as the We Company. This move, according to company statements, reflected its expanded ambitions beyond co-working spaces into residential living with WeLive and educational initiatives with WeGrow. Critics, however, viewed this as an attempt to pivot away from its core, less glamorous real estate identity, making it appear more like a tech-driven ecosystem deserving of a higher valuation multiple. The rebranding underscored a strategic effort to project an image far grander than its operational footprint. WeWork's fundamental business model involved signing long-term leases for large office spaces, often 10 to 15 years, and then subdividing these spaces into smaller, flexible offices that it subleased to individuals and companies on short-term, month-to-month, or yearly contracts. This strategy, as reports from financial analysts at the time indicated, created a significant mismatch between its liabilities and assets. While presented as an innovative disruption, the model fundamentally amplified real estate market risk by transforming stable long-term commitments into volatile, short-term revenue streams. The concept of lease arbitrage was central to WeWork's profitability claims. The company aimed to profit by charging more for its flexible memberships than it paid in long-term lease obligations. However, this model inherently assumes stable or rising demand for office space, and critically, a steady spread between long-term lease rates and short-term flexible workspace pricing. Experts like Professor Scott Galloway observed that this arbitrage was highly vulnerable to economic downturns, where demand could drop suddenly, leaving WeWork with significant fixed costs and dwindling revenue. WeWork's rapid expansion was fueled by enormous capital injections, primarily from SoftBank and its Vision Fund. Early funding rounds saw a gradual escalation in valuation. By 2017, SoftBank invested over $4 billion, a move that positioned the Japanese conglomerate as a key backer and propelled WeWork's valuation past many established companies. Masayoshi Son, SoftBank's CEO, became a staunch advocate for Neumann's vision, often encouraging even more aggressive growth, a strategy that would later face intense scrutiny. The company's valuation trajectory was meteoric. From a reported $5 billion valuation in 2014, it surged to $10 billion in 2015, then an astonishing $20 billion by 2017. The apex arrived in January 2019 with SoftBank's final pre-IPO investment round, valuing WeWork at a staggering $47 billion. This valuation, according to sources close to the deals, was largely predicated on its perceived status as a tech company rather than a conventional real estate operation, justifying a higher multiple on future growth potential. SoftBank's substantial investments provided critical capital for WeWork's global expansion, allowing it to open hundreds of locations across dozens of countries. However, this deep financial reliance also arguably fostered an environment of unchecked growth and limited accountability. Critics suggested SoftBank's blitz-scaling philosophy, focused on rapid market domination, perhaps prioritized expansion over sustainable financial fundamentals, as evidenced by analysis from publications like The Wall Street Journal. This became a double-edged sword, enabling growth but also masking underlying issues. As WeWork prepared for its public offering, details emerged from its S-1 filing that highlighted significant corporate governance concerns. Adam Neumann, as CEO, held disproportionate control, possessing supervoting shares that gave him a majority of voting power despite not owning a majority of equity. Reports from the filing also detailed instances of self-dealing, including Neumann personally leasing properties to WeWork and the company paying him millions for the We trademark, which he had previously acquired. One of the most glaring instances of perceived self-dealing involved WeWork's purchase of the We trademark from Adam Neumann for nearly $6 million. Neumann had registered the trademark personally just months before the company's rebranding to the We Company. While the company stated this was a standard legal transaction, investors and the public viewed it as a stark example of a CEO profiting directly from his own company's assets, fueling skepticism about the company's ethical standards in financial management. Adam Neumann frequently blurred the lines between his personal lifestyle and WeWork's corporate operations. Reports from various media outlets, including Vanity Fair, detailed lavish parties, private jets, and a corporate culture that seemed to prioritize exuberance over fiscal discipline. While some argued this fostered a unique, appealing culture, financial analysts questioned the prudence of such expenditures for a company yet to achieve consistent profitability, especially given its reliance on investor capital. The S-1 prospectus, filed publicly in August 2019, was meant to garner investor confidence for the IPO but instead exposed alarming financial realities. It revealed substantial losses, accelerating year over year. For example, in 2018, WeWork reported a net loss of $1.9 billion on revenues of $1.8 billion. This stark contrast between revenue and loss immediately raised red flags for potential investors, as outlined by financial journalists at Reuters, highlighting a growth-at-any-cost strategy without a clear path to profitability. The S-1 filing laid bare the company's dramatic losses, which were not only significant in absolute terms but also growing rapidly alongside its revenue. This challenged the narrative of a maturing business moving towards profitability. Analysts struggled to reconcile the company's escalating burn rate with its lofty valuation, prompting serious questions about its long-term financial viability. The $47 billion private valuation raised eyebrows, especially when compared to established players in the real estate sector or even other tech darlings. Critics argued that WeWork, fundamentally a landlord, was valued more like a high-growth software company. This comparison became a cornerstone of investor skepticism, questioning the metrics used to justify such a premium. The market struggled to categorize WeWork, highlighting a fundamental misalignment between its business operations and its public perception. To justify its tech valuation, WeWork emphasized its community aspect and user engagement. Neumann often spoke of energy-adjusted EBITDA, a non-GAAP metric that bewildered traditional financial analysts. The company also presented community-adjusted EBITDA in its S-1, which excluded various expenses including marketing, general and administrative costs, and even interest and taxes. This highly unconventional metric, as reported by Bloomberg, was widely criticized for obscuring actual profitability and painted in an overly optimistic financial picture. The S-1 filing and the subsequent roadshow were met with overwhelming skepticism from institutional investors. The aggressive losses, the unconventional governance, and the founder's erratic behavior became central points of concern. Analysts at major banks reportedly struggled to justify the target valuation of around $47 billion, which was considered unrealistic by public market standards for a company with such a financial profile. The narrative spun by Adam Neumann simply did not resonate with the rigorous due diligence of public market investors. Reports detailing Adam Neumann's personal conduct began to surface, further eroding investor confidence. These included instances of smoking marijuana on a private jet, purchasing and investing in properties WeWork later leased, and even claiming he wanted to be president of the world. While some venture capitalists might tolerate such eccentricities in private, public investors scrutinize leadership more rigorously. His perceived lack of financial discipline and corporate professionalism, documented by publications like Forbes, became a significant deterrent. The public backlash, fueled by both the S-1 disclosures and Neumann's controversial actions, rapidly eroded investor confidence. A key sentiment among potential investors was encapsulated by a prominent venture capitalist. The market was signaling that WeWork's private valuation was simply unsustainable in the public domain, a stark contrast to its initial investor-backed enthusiasm. Facing severe investor pushback, WeWork was forced to delay its highly anticipated initial public offering in September 2019. This delay was accompanied by a dramatic revision of its expected valuation, which plummeted from $47 billion to an estimated $10 to $15 billion by some analysts, and even lower by others. The market, in essence, repriced WeWork as a real estate company, not a tech giant, highlighting the chasm between private market enthusiasm and public market pragmatism. SoftBank, WeWork's largest investor, found itself in a precarious position. Having poured billions into the company at peak valuations, a failed IPO threatened massive write-downs for its vision fund. This created immense pressure for Masayoshi Son to intervene, both to salvage his investment and to protect SoftBank's reputation. The dilemma was clear: either let WeWork collapse and incur significant losses, or inject more capital and attempt to stabilize the company. The mounting pressure from investors and the board, heavily influenced by SoftBank, culminated in Adam Neumann's resignation as CEO in September 2019. He stepped down but retained his non-executive chairman role initially, although he was later fully removed. Neumann's departure was widely seen as a necessary step to restore investor confidence and salvage the company's future, as reported by the New York Times, but it came with a significant exit package, which itself drew criticism. Despite being largely responsible for the company's precarious position, Adam Neumann secured a controversial exit package from SoftBank. This deal reportedly included a $1.7 billion payout in the form of a credit line, stock tender, and a consulting fee, though parts of it were later revised or challenged. For many, this compensation, while shareholders faced massive losses, symbolized a stark inequity and fueled public outrage, becoming another black mark on WeWork's troubled narrative. In October 2019, SoftBank stepped in with a comprehensive bailout package designed to prevent WeWork's imminent collapse. This rescue deal valued WeWork at a mere $8 billion, a dramatic 83% drop from its January valuation. The package included $5 billion in new debt financing and a tender offer for $3 billion worth of WeWork shares, which granted SoftBank even greater control, effectively making it the majority owner. This move was a desperate measure to protect its prior investments. Following Neumann's departure, WeWork appointed Artie Minson and Sebastian Gunningham as co-CEOs, tasked with stabilizing the company and implementing drastic cost-cutting measures. Their initial efforts focused on divesting non-core businesses like WeLive and WeGrow, reducing its global footprint, and laying off thousands of employees. This new leadership aimed to steer WeWork back to its core flexible workspace offering and demonstrate a clear path to profitability, a stark pivot from the aggressive expansion of the Neumann era. The post-Neumann era saw immediate and widespread layoffs as the new leadership scrambled to reduce the company's exorbitant operational costs and stem its financial bleeding. These job cuts were a stark indicator of the company's overexpansion and the severe misjudgment of its market strategy under the previous regime. The human cost of the ambition was significant, impacting thousands of employees globally. WeWork's tumultuous journey sent ripples through the commercial real estate sector. Its model had initially been embraced by landlords looking to fill vacant spaces, but its near collapse prompted a re-evaluation of the flexible office space market. Landlords became warier of relying solely on co-working operators, leading to a shift towards more direct partnerships and revenue-sharing agreements rather than traditional long-term leases, as reported by industry analysis from Cushman and Wakefield. The industry learned to scrutinize the financials of such operators more closely. The WeWork saga provided a crucial cautionary tale for the tech investment landscape, particularly concerning private market valuations and the growth at all costs mentality. It highlighted the dangers of inflated metrics and the blurring of lines between tech innovation and traditional industries. Investors, particularly SoftBank, faced intense scrutiny for enabling such a valuation without sufficient fundamental scrutiny, prompting a more conservative approach to funding highly speculative ventures, as noted by financial commentators. SoftBank's aggressive investments in WeWork and other struggling unicorns like Wirecard and Zoom Pizza led to significant write-downs and damaged the Vision Fund's reputation. Masayoshi Son publicly admitted to poor judgment regarding Adam Neumann, acknowledging that he had been fooled. This public admission, covered widely by financial news, underscored the high-stakes risks associated with SoftBank's investment strategy and led to increased pressure for more rigorous due diligence in future deals. WeWork's implosion ignited a broader debate about the unicorn bubble, privately held startups valued at over $1 billion. Critics argued that venture capital firms, flush with cash, were artificially inflating valuations, delaying IPOs, and shielding companies from public market scrutiny for too long. WeWork became the poster child for this phenomenon, demonstrating how a lack of transparency and an over-reliance on growth narratives could lead to catastrophic re-ratings once public market realities set in. In March 2021, WeWork announced another attempt to go public, this time through a SPAC, Special Purpose Acquisition Company, merger with Boex Acquisition Corporation. This move aimed to bypass the traditional IPO process, which had proven disastrous. The SPAC route offered a different path, providing a less rigorous regulatory review and a predetermined valuation, often seen as a way for companies with troubled histories to finally access public markets. The SPAC merger, completed in October 2021, valued WeWork at a significantly reduced $9 billion. This was a stark contrast to its initial $47 billion peak valuation, representing an 80% decrease. This new valuation reflected a more realistic assessment of the company's underlying real estate business and its substantial debt load, incorporating the harsh lessons learned from its initial public market rejection. After going public via SPAC, WeWork continued to face financial challenges. Its stock price struggled to gain traction, often trading below its merger valuation. The global pandemic further complicated matters, as demand for office space, particularly flexible options, was severely impacted by remote work trends. While the company continued to cut costs and rationalize its portfolio, profitability remained elusive, putting sustained pressure on its ability to prove its long-term viability to public investors. Despite his dramatic exit from WeWork, Adam Neumann resurfaced with new ventures, notably Flowcarbon, a blockchain-based climate tech startup, and Flow, a residential real estate company. Intriguingly, his new real estate endeavor, Flow, also garnered significant investment from Andreessen Horowitz, a prominent venture capital firm, at a reported valuation of $1 billion. This renewed backing for Neumann, despite his past controversies, raised questions about accountability in the venture capital world. The WeWork saga brought critical questions about corporate accountability and governance to the forefront. The board's initial deference to a charismatic founder, combined with SoftBank's deep pockets, allowed a culture of lax oversight to flourish. The lessons learned underscore the necessity of robust independent boards and stringent financial controls, particularly in fast-growing startups aiming for public markets, as emphasized by corporate governance experts. Today, WeWork continues its efforts to navigate a challenging market, aiming for sustained profitability. Its journey from a $47 billion darling to a heavily scrutinized public company serves as a powerful case study in the perils of hype over fundamentals. The long-term question remains, can WeWork, under new leadership and with a chastened strategy, ultimately prove the viability of its flexible workspace model, or will its initial missteps forever overshadow its operational potential? WeWork's core claim to be a technology company, rather than a real estate operation, was central to its inflated valuation. It built apps and provided services, but its primary business remained leasing physical spaces. This tech-wash tactic, as many critics termed it, allowed investors to apply tech multiples to a business with real estate margins, fundamentally misrepresenting its risk profile and potential returns. The mirage ultimately shattered under public market scrutiny. The fallout from WeWork's attempted IPO significantly shifted market sentiment towards high-growth, unprofitable companies. Investors became more discerning, prioritizing clear paths to profitability and sustainable unit economics over sheer scale and user numbers. This marked a turning point, moving away from an era where massive losses were simply accepted as the cost of disruption, towards a demand for clearer financial viability, impacting numerous other unicorn startups. From the venture capital perspective, WeWork was seen by some as a necessary, albeit painful, learning experience. It underscored the inherent risks of aggressive investment strategies and the importance of due diligence, even for highly charismatic founders. The experience highlighted the tension between fostering innovation and safeguarding investor capital, a balance that can be difficult to maintain under pressure for outsized returns. Despite SoftBank's bailout, WeWork continued to grapple with a substantial debt burden. The long-term lease obligations remained a significant liability on its balance sheet, necessitating continuous occupancy rates and efficient operations to service these commitments. This structural challenge, inherent to its core business model, meant that even with cost-cutting, the company faced an uphill battle to achieve sustainable positive cash flow, as financial statements consistently indicated. The story of WeWork serves as a powerful testament to the intoxicating allure of hypergrowth, charismatic leadership, and the promise of disruption. Its journey from a $47 billion valuation to near collapse and a subsequent, much-reduced public offering, encapsulates a complex interplay of vision, capital, and corporate governance failures. The WeWork disaster isn't just a tale of lost billions, it's a profound case study in how market irrationality can clash with fundamental economics, leaving a lasting impact on investment strategies and the startup ecosystem alike.